Hello students. So today we will do the another part of income tax, the income from house property. So before starting the chapter, you should know what actually a house property is. Any property which should consist of any building or the land appertaining thereto. The assessee should be the owner of such property, and the property should not be used for the purpose of any business or profession carried on by the SEC, the profits of which are chargeable to income tax. So these three conditions, if they are fulfilled, it's known as the house property. And if that house property is rented, so whatever income the owner is receiving, is earning actually, will be included under income from house property. A house property may be self-occupied or it may be rented. So when you are doing a problem on house property, you have to be very careful that which portion is rented and which portion is actually self-occupied, because the valuation are a bit different. So let's start. The basis of charge means the calculation is mainly on the annual value of the house property. This is the inherent capacity of the property to earn income. The charge is not because of the receipt of an income, but is on the inherent potential of the house property to generate income. So it means if you have a house which is not actually rented, which is vacant in nature, or it is actually self-occupied, then still there will be an annual value of that house property because of the potentiality of earning income from that property. The conditions to be fulfilled for the property income to be taxable under this head, whatever I said, the 3 points, the buildings and the land appertaining thereto, he should be the owner, and the house should not be used for any other purpose like business or profession. Now, apart from the owner, there is a concept called deemed owner. Now, who is a deemed owner? He is the legal owner of the house property who is chargeable to tax in respect of property income. And the following persons, like an individual who transfers house property otherwise than for adequate consideration. Remember that if there is a transfer, there should be an adequate consideration, not with a revocable transfer or not with a gift, or to his minor child, not being a married daughter, is the deemed owner of the house property. The holder of an impartable estate is a deemed owner of all the properties comprised in that estate. Or a member of a cooperative society or a company, or the AOP means association of person, to whom a building or a part thereof is allotted or leased under a house building, is also the deemed owner of a house property. Now, what is a composite rent? There are some cases, suppose you have a house and you have a garage and you have a garden. And what you did in that house, in the ground floor you are staying, the first floor is being rented, the portion of the garage is rented, and the portion of your garden is rented. So actually you will say the whatever income I'm earning by renting, by giving rent to the house property, will be under income from house property, but that is wrong. Because of the logic with the land opportunity there too, there will be some composite rent. Means whatever you are earning from that garage, from that garden, which are actually the part of the land on which the house property is established, is also under the composite rent. So also they will be included under income from house property. So composite rent on account of rent for the property and the service charges for various facilities provided along with the house, like lift, gas, water, electricity, wash and ward, air conditioning, etc. In this case, such composite rent should be split up, and portion of the rent attributable to the letting in the premises shall be assessable as income from house property. The other portion of the composite rent received for rendering services shall be assessable as income from other sources. So remember, the total income you are earning will be under income from that. Those are actually the eligible for the income tax, but the portion you are earning from the house will be under income from house property, and the other sources means the other source like the garden, like the garage, and like the other properties will be under income from other sources. But the composite rent is a concept like the other services you are offering or you are getting along with the house. Now, there are some other definitions and logics and parameters for the composite rent. Now, these are the some exception which are not charged for the house property, like income from any other farmhouse, annual value of any place in the occupation of the ex-ruler, income from house property to a local authority, to an approved scientific research, registered trade union, political party, income from house property held for any charitable purpose. These are excluded from income from house property. Now, in the second slide, we have seen the valuation of house property is dependent on the annual value. Now, what is an annual value? Annual value including all these three things: the actual rent receipt or receivable, the municipal value, the fair rent of the property, and the standard rent. So in short, you can write like MFSA means there will be municipal value, the M, F means the fair value, S means the standard rent, and A means the actual rent or the annual rent. So whenever we are calculating the gross annual value or the annual value, it will be in that order: the M, the F, the S, and the A. Now, first we will take the M and F. In your problem, there will be given the municipal valuation and there will be fair rent. So the higher value will be taken from the M and the F. After that, that will be compared with the standard rent, means the S. So whichever is the lower, we will take that as the expected rent, and that expected rent will be compared with the actual rent. Then the higher value will be taken as the gross annual value. From the gross annual value, we will deduct the municipal taxes. Now the municipal tax percentage will be given in the sum, and always the tax will be calculated on the municipal value. Remember the thing, the municipal taxes should have been borne by the owner. If it is paid by the tenant, it will not be considered, and these have been actually paid during the previous year. If it is due, also will not be considered for the problem. So from GAV or the gross annual value, we will deduct the municipal tax and we will get the net annual value. Now from net annual value, there are some basic deductions under section 24A and under section 24B. From net annual value, after this deduction 24A and 24B, we will get the total taxable income from house property. Now what, like, look at this format. First the GAV, but before that there is AMFSA. From the calculation we will get the GAV, then we will deduct the municipal tax from there, we will get the NFE, the net annual value, then the deduction under section 24. First the standard deduction. Now what is the standard deduction? The 30% of NAV. So whatever the NAV value is, we will deduct the 30% as a standard deduction. Now there is interest on borrowed capital. Now what is interest on borrowed capital? It is actually the loan taken to make the house. If you take a loan from bank or from any financial institution to make the house, you have to pay some interest. So depending on the amount of interest, we will get the deduction. The normal rule for interest on borrowed capital is the actual interest paid or rupees 1,50,000, whichever is minimum will appear here. So if I say for an example, if my my interest on loan is rupees 70,000 per annum, so I will get a deduction for rupees 70,000. Why? Because 70,000 and 1,50,000, 70,000 is lower, so that amount is permissible here. Now from NAV, if we deduct this 24 deduction, we will get the income from house property, which is eligible for taxation. I'm going to a problem. There is house 1, there is house 2. There's a standard problem. Look, there is MFSA, municipal tax is given, and there are some other expenses and informations. So we will start the problem. First, the house 1, the expected rent we are getting. So the GAV 78,000 for the house 1 and 85,000 for house 2. Then we are deducting the municipal tax. It is due, not it is due. So that is why it is not coming or not eligible to come. Then the NAV, then the standard deduction 30% on 78,000 is 23,400, and interest on bulk capital 23,400 is nil here, and 14,000, because if we go to the sum we will see for the house 1 there is nothing, and for the funds that used for the construction of the house for the house 2 14,000, so that is eligible for the house 2. So that is why 14,000 is appearing for the house 2. So for house 1, NAV minus standard deduction 54,600, and for the house 2, 85,000 minus 14,000 means 45,500, 13,500. So the total income from house 1 is 54,600 and house 2 is 45,500. So from there, my total income from house property is 1,100,000, and the income for business in the sum we are seeing here, the income for business is 46,000. That will be added. So my total income is 1,46,100. So this is the standard problem where we have the income from business, we have two houses, we have the informations. So first we will calculate the income from house property, then we will add the income from business, and the total will be my taxable income, means 1,46,100. So we will pay tax on that. So hope we have understood the income from house property. In the next class, we will do income from other sources. Thank you.